Hi, I'm Greg Weldon. I'm your host for Money, Markets, and New Age Investing. And this is episode number 1 of season 2, kicking off our second season. And we're going to start with what's happened since the last podcast in terms of the Fed, in terms of the perception that the Fed is kind of signaling that it's done raising interest rates, the degree to which the markets, the forward markets in the short-term interest rate futures are pricing in rate cuts, and it's doing so across the board geographically. In the U.S., the current Fed funds spot market, 5.4%. For the end of next year, 4.5%. You're looking for a 90 basis point decline. Basically, you're looking for 3 to 4 rate cuts of 25 basis points by the end of next year in the U.S. by the Fed. There is some expectation that the first rate cut could come as early as March. As early as March. All right? And we'll talk about that insanity in a second. In the EU, the 3-month rate at 4.08, the end of next year, 3.22. So you're talking about 75 basis points, 3 rate cuts priced in from the ECB for next year. And the Bank of England in the short sterling is 540, current spot for the end of this year, December, and 466. So you're looking at 3 25 basis point rate cuts priced into the markets for next year in the US, Europe, and the UK. You could see similar things if you wanted to look at the RBNZ in New Zealand, the RBA in Australia, the Bank of Canada. And frankly, you already have rate cuts taking place in a lot of places, like I talked about last episode, that a place like Brazil, for example, has cut rates multiple times already. So this is, fostered this kind of mini feeding frenzy in equities. Now, I would say, before I get too far ahead of myself, that I find it interesting that this degree of rate cuts is priced into the market, and the S&P is not even at new highs. Think about that for a second. So, and then think about, well, what if they're not cutting rates by March or June? You remember what happened last time it became evident that they weren't done, which was July, and what happened since then? So in that context, the end of July and through August, Humphrey Hawkins specifically. So the degree to which we come now, and the question then becomes, is this an inflation issue? All right. Can inflation come back? And if it does, how does that potentially hamper the Fed? And then, does it even hamper the Fed? And we'll get to that in a second. But it's important to note, in the context of where the markets are projecting interest rates to be a year from now, 4.5 in the US, 3.25 in the EU, 4.5 in the UK. Let's look at some of the CPI numbers. Everyone celebrated the CPI report, which just came out, as being, everything kind of accelerated in terms of bond prices going higher, yields going lower, dollar down specifically. So in that context, let's look at some of the things from the CPI report. I'm going to give you a lot of numbers today because it's important, because the facts matter. The numbers are what define kind of where we're at, not opinion. I'm not about opinion. I'm about looking at all the numbers, looking at the patterns, putting the pieces together, and then forging some thoughts around what might happen. And it's not what I think will happen. Of course, I have an opinion. But it's also, what if I'm wrong? What if this happens? Or what if this happens? Or what if this happens? Because then we've thought about it, and we kind of have a sense of what we think we would do if that situation plays out. That's really kind of a big part of what we do in terms of managing money. It's not just, here's what I think it is, and plow all the money in there. I mean, no way, man, because, I could be wrong, and it has to be much more systematic. I'm not a system guy, even though I could be. I'm a math guy. But there has to be a methodology to it. And in the context of the interest rate cuts that are priced into the markets all over the place that are driving the action right now, and probably will continue to drive the action, I am not saying that I don't think we can't see that outcome with those interest rates. We could. But there's a lot of things to go through before we get there. And that's what the market's not pricing in. All right. Let's look at some of the components of CPI that you don't think about, because The thing here is the Fed kept saying we don't want to have inflation embedded. It's embedded. Just by the numbers I'm about to give you, it's embedded because it's in every little nook and cranny. It is like, and I did a piece back in 2021 about what the great squid, the giant squid. There's a name for the giant squid. I can't remember off the top of my head, but that was the name of the piece. And the giant squid was inflation. And the ship was the economy. And the squid grabs hold of the ship, and the tentacles and the little suction cups get into every little nook and cranny of the ship, every room, every little, the hold and the captain's quarters and everywhere. That's inflation coming embedded when trash collection is up 6.5%. Household operations up 6.7%. 6.5% for trash a year, you're paying more. Dental work, 4.9%. Personal care, excluding cosmetics, toothpaste and mouthwash and anything like that. 6.6%. Hair products, 6.6%. Cigarettes, 7.6%. Beer, 5%. So some people are really hurting there. Luckily, not me. Wine, 5.3%. Distilled spirits, 7%. The wine and distilled spirits are if you're out buying them. Rent, of course, 7.2%. That's problematic because rent's once a year. It's the biggest monthly expense, and it's not coming down anytime soon, as you'll understand when I get to the housing part of today's podcast. Non-prescription drugs up 8.1%. Prescription drugs were up 0.8% for the month, which is almost 8% annualized, over 8% annualized. Pets and pet supplies up 6.5%. Men's and boys apparel up 5.3%. Shirts up 6.7%. Pants and shorts up 8.1%. Paper products up 6.3%. All right. Hospital visits up 5.6%, and it was up 1.1% for the month. All right. Now, some of the food items, it's interesting because we talked about this. Food, a lot of food items came down and have already bottomed and have already started to rise again, and now it's showing up. Beef up 1.2% for the month. Pork up 1.3% for the month. Automobile insurance up 1.9% for the month after being up 1.3% in September for the month. Who doesn't have to pay auto insurance? Trash collection, dental work, personal care products. I mean, it's in everything. Clothing, paper products, drugs. In the food category, 5 out of 6 of the major grocery groups that the Bureau of Labor Statistics, which puts out the inflation numbers, oddly enough, published, all right? 5 out of 6 were up. Vegetables and fruits was the only single category down, that didn't rise, and it was unchanged, all right? Now, I love to look at the city inflation numbers, and they come out every other month for each city. So it's a rolling, certain cities come this month, and other cities next month, and the cities that came this month will be 2 months from now, and so on and so forth. Obviously, most people live in the cities. So this affects most people. Let's look at some of the changes in the city numbers for October since August, 2-month change. San Diego, 4.9, up from 4.3. New York City, New Jersey, 3.5, up from 2.5. Tampa, St. Pete, 6.7, up from 5.9. Denver, 5.4, up from 4.7. All of these now from here on after we get to this. 3.5 for Philly, up from 3.1. 7.4 for Miami, Palm Beach, up from 6.9. Dallas, Fort Worth, 4.6, up from 4. Riverside, San Bernardino. Is it Bernardino? No, Bernardino. I'm thinking of Frank Zappa. 4.9, up from 3.9. Washington, D.C., 3.3, up from 1.8. How does Washington, D.C. have the lowest inflation rate in the country? How is that fair that the politicians in Washington, while they're in Washington, have the lowest inflation in the country? Something's wrong with that picture. The other place would be Houston. Houston, 3.0, up from 1.7. The point is these increases are huge on the year-over-year basis. So I thought that was just kind of interesting in terms of, looking at where people live and all that. So now things that were down, energy, Gas was down 5% for the month. Energy is still down year over year. Base effect, because energy has come down on a monthly basis, it's kind of wiped clean some of the base effect. That's a big positive. That's kind of where, when we get to the strategy part of today's podcast, we'll talk about that. That's why some of the things we kind of play the reflation play, at least in some places. I prefer not equities. But moving costs were down, and so were storage costs, self-storage. So isn't it interesting, as that real estate market gets crushed and prices so high that no one can move, that moving and storage costs go down, and this affects the inflation numbers. Import prices came out down 0.8 for the month. They've been down 10 in a row. 10 in a row. This is the biggest monthly decline since March. Down 2% year over year, accelerating lower from down 1.5, and again down 10 in a row in terms of the year over year number. That's import prices. PPI came out this week, down 0.5 for the year. It's the third biggest decline in PPI since the 2008-2009 crisis. The only times we've seen this before in the pandemic and in 2015. So it's the third worst decline in PPI in 14 years. The core rate at 2.4, 2.3 would be a major breakdown to core PPI. All right. Core finished goods, the lowest since June of 2022, and intermediate demand service PPI. So service PPI is coming down fast, and it had been really high. And at 3.5, intermediate demand for services is still high, but it's the lowest in 2 years, and it's down from 6.9 a year ago. And it's down from 4% a month ago at 3.5. Now, what's interesting, and that a lot of people don't realize, is PPI, when it comes to some of these businesses, it measures the price pressures by the pressure on margins. It's not even really prices, it's margin pressure. So, you could mistake a really negative PPI number as deflation in prices when it's not. It's crushed margins, and that's not good for stocks. So that's what's really interesting here. Let's look at some of the service industries that posted outright deflation because of margin pressure. Machinery, vehicle wholesaling, apparel, footwear, traveler services, portfolio management, oddly enough, healthcare, beauty and personal care, optical goods, rental of retail properties, food wholesaling, ocean freight. ISM, by the way, noted freight costs coming down too. So that's really interesting to me. This is margin pressure. All these businesses are kind of in deflation because their margins are getting crushed. They can't pass along the price increases of the prices paid. The prices received have not kept pace. And now it's kind of reversing. And so that's interesting. Capacity utilization came out. Normally I wouldn't, I don't pay too much attention to it. And yeah, the automobile strike is going to impact the industrial numbers, no doubt. But this number was expected to rise for the month. It didn't. It fell by 0.5. That's a big decline from 79.4 CAPU to 78.9. It's the lowest since February of 2021. It's a full percentage point below the 40-year average. CAPU not contributing to inflation, understanding it's not as big a component of inflation as it used to be. This is still interesting to me because it was expected to rise despite the strike, and it fell in a big way. Just another little tell, that's all. All right, breaking down other data here is interesting because we get some economic data that really show us that, inflation's embedded. Yes, the year over year and the headline rates have come down, and, but are they going to get to 2 and then stay there? And if, and they're going to get to 2 and stay there by the end of June, the Fed is higher longer, and they want to ensure that inflation is defeated, and they want pain in the economy before they're going to be even, talking about shifting gears. So what has to happen is pain in the economy, pain in the markets. We're getting some of that pain in the economy. And like I said in the last podcast, if you look at the real Fed funds rate and measure that as whether the Fed is tight or loose, all right, the Fed was loose right up until May of this year. It's only May of this year that the real policy rate got to a restrictive position. So they've only been restrictive for like 5 months. So now you're starting to see the rollover, right? Everyone's like, why is the economy not collapsed? Why is the economy not collapsed? It's not going to be a recession. Oh my God. No, because when they started hiking rates, they were the most stimulative real Fed funds policy rate in history. In history, inflation is like 8%. Fed funds rate was still 25 basis points. That's minus 775 real rate. The lowest, deepest negative in history. The most stimulative in history. So, of course, the economy hasn't shown the signs of it outside of, mortgages and housing and real estate. Now you're starting to see it because now they've been restrictive for several months. There's a lag time. You're starting to hit the lag time. It's right in there. 5-6 months, you're there. The Philly Fed, the entire 2023 spike in the Outlook Index got really optimistic this year, is gone in a matter of 3 months. All right. And you have the current and the Outlook Index in the Philly Fed survey, both negative. The last time we saw that, 2008. 2008. Not even in a pandemic did this get negative. Not even in a tech bubble crash was this negative. It's negative now. All right. The current run of negative numbers in the current current conditions index, all right, only 3 times have we ever seen this kind of run before. 1990, 2000, and 2008. All right. And margin pressure shows up here. And so what happens? Businesses said we've seen this in the Beige Book and in Fed regional surveys. Businesses are saying, we're so hurting. Margins are getting crushed so much, we have to try and raise prices. All right. So the Philly Fed, the current percentage of firms from the Philly Fed raising their prices received, in other words, for their own goods, when they sell them, their final, price received versus what they're paying to make them. Current number of hiking prices received, 21%. 6 months from now, 46.3%. More than double the number of firms that are raising prices now expect to be raising prices within the next 6 months. The Fed knows this. I mean, they're concerned. It's embedded. You do have a base effect coming into play that's not going to be as powerful as it would have been, 3 months ago because of energy's come down. Then we look at the labor market. They're looking for pain in the labor market. We have it. Initial claims for unemployment benefits, 231,000 the most recent week. That's up from 218 the week before. Big jump on a week-to-week basis. And the number of people receiving benefits rose 32,000 to 1.865 million. That's up 207,000 in the last 8 weeks. 207,000 people now receiving unemployment benefits that 8 weeks ago were not. It's above the April high, and it's the highest since December of 2021 when it was coming down after the pandemic. How about retail sales? The consumer's strong. Everyone keeps saying that. No. The year-over-year rate dropped to 2.5 from 4.1. Relative to inflation, that's negative. Further, there's 21 indexes that the Commerce Department breaks down for retail sales, in which they give you industry sectors like sporting goods, online shopping, eating and drinking establishments, vehicles, so on and so forth. Of the 21 indexes, only 3 of them showed an increase in the year-over-year rate of change. That's 14%. The rest of them showed declines. All right. Only 13 of 21 showed a decline for the month. 13 of 21. Only 4 showed declines in September. So you went from 19% of the sector showing monthly declines to 62% showing monthly declines. Now, let me look at it a different way. Because if we take this month's change being October from September and then compare it to last year's September to October sales, and let's get a different view of how this year-over-year dynamic is. And let's see what the change was last year in dollar terms and what the change is this year in dollar terms from month to month, and compare the two. Online sales. The increase last year was the increase last year was 1.37 billion. 1.37 billion last year. This year, 270 million. That's an 80.2% decline in the growth of online sales. Vehicles, last year, 2.73 billion was the increase from September to October. This year was a decrease of 1.29 billion, a 4 billion complete flip-flop negative reversal in vehicle sales. No growth, now deflation, or growth to deflation. Eating and drinking establishments. And I use online sales and eating and drinking establishments because they're the two most sensitive and robust and resilient discretionary spending sectors. All right, so online sales, your increase this year, 80% below last year's increase. For eating and drinking establishments, this year, $270 million versus last year, $1.5 billion. 81.4% decline. Also, sectors posting reversals of more than $100 million from last year: furniture, sporting goods, and clothing. I mean, that's dramatically bad and broad in its negativity. All right. Not only that, real retail sales, the headline number, has been negative 8 out of 9 months, 10 out of the last 12. That's only happened once in the last 40 years. 2008, 2009. I mean, come on. Say the economy is strong. I don't see it. All right, so what's the strategy here? What do we do? All right, do we plow into stocks? Well, for some people, that's what they're doing. And I say no. That's not the preferred way for me. I mean, the Fed is not going to be cutting rates, certainly not by March. They're not going to. Okay, they already say we expect pain in labor. We expect pain in the economy, below trend growth for a period of time. So they want to be able to declare victory over inflation. That would require some slowdown in demand. And they just said that the slowdown in demand may need to be bigger than we thought it would be originally because the economy has been so robust that a strengthening economy will cause us to raise rates. What's the biggest risk to inflation right now would be the Fed cutting rates in March. So they're not going to do it. So they want to see that eradicated from the forward market, so they're going to continue to talk hawkishly. All right. But inflation's embedded too. That's not good. All right. It's a 40-year downtrend that is reversed. It's going to be higher. You know, it's not getting back down to 2%. I'd say 2% at some point becomes the floor for the target rate. All right. So in that case, they're not going to be cutting rates anytime soon. There's no fiscal latitude here. No fiscal latitude whatsoever. You do that, the yield curve is going to pop and the bond market gets whacked. I think the yield curve pops anyway because the Fed acquiesces to higher inflation, keeps short rates lower to support the economy, and I mean 2 steps down the road. And the long end takes the brunt of the inflation and the supply vis-a-vis debt and fiscal deficits dynamic, and the curve steepens like crazy. How are you going to invest in a market where the margins are getting crushed? You can't declare inflation over, and you will cut only if the economy is in recession, and the market would have to take us there. So maybe that's the way it has to go. I mean, and you're now pricing in cut, and besides info technology, and the NASDAQ broader market's not making new highs here. And so let's go back to the consumer, because the New York Fed survey was really interesting. They do a survey every month. They do a household survey, right? Better off versus worse off a year from now. What's the expectation? Let's go back to before the pandemic, 2019. All right. What was expected would be much worse off was 12%, 11.9. July, those expecting worse off 12 months from now, 26.6. Now it's 30.9. It's tripled, and it's at a new high for this little cycle. It was higher a year ago, but for this, it came down, and now it's going back up. Versus the better off, in 2019, it was 44%. July, it was 29. Now it's 28. So we see from July, where it was a +3 positive in better off expectations a year from now, it's -2% net. More people think they're going to be worse off 12 months from now. I mean, that's the problem. Are you going to invest in stocks on that? So what do you do? I'd rather play other places. I really like emerging markets. I mean, they've been under pressure, underperformed. The currencies have gotten crushed. All right. They have interest rates that are really high and much higher than inflation, which has come down. So this is the places where they can really cut rates fast, like Brazil. And that will really benefit the markets. And if you get the currencies to stabilize, you'll have capital inflow. You had an election over the weekend where a libertarian won in Argentina. Peronist since the 40s. They're going to dump the central bank. They're going to dump the peso. And this doesn't hurt Brazil. Brazil is one of the places I like. I like the currency there. I like any currency that's emerging market that has resource or commodity production, especially as net exporters, and especially if they are net exporters to China, and especially if it's one of the currencies China would like to include in the new paradigm basket of currencies that will replace the dollar as the means of global trade, like the Brazilian real. Good example. EWZ is the Brazilian stock index ETF. I like that. It's breaking out. The Brazilian real trades, of course, over the counter or in the futures market. I like that. There's others that I like in emerging markets in that same vein. And this we give to our clients in our money markets and new age investing portfolio playbook. Okay, because we want to help people, and they're going to have to do things like currencies and emerging markets. Emerging markets should outperform. The ILF is the South American ETF, along with the EWZ. So in that case, I also like the commodity sector. We've talked about this. Gold, we've talked about the ags, still there, soybeans, SOYB, cane, CANE. The DBA is the ag commodity ETF. Those are the ETFs. Gold, of course, GLD. And now silver. I see silver at $30 and we're probably going to be a fast and furious move at some point in the not too distant future. All right, crypto. Our call on Bitcoin and Ethereum paid huge dividends. Hopefully you participated in that. Our clients are loving it, both the money management side and the research side. If you're not involved, that's part of our portfolio playbook and part of our overall macro strategy report as well. But how about real estate? Could real estate be the hottest sector in 2024? It very well could be. I don't think mortgage rates are going to go back up, at least not to the degree they've gone up. That's for sure. That's almost a mathematical certainty. All right. And when the Fed does cut rates, it's going to be a feeding frenzy in the housing market. And you don't have enough homes. It is a shortage of supply. So if housing is a commodity market, it is very dramatically undersupplied. And this is a shortage where the backwardation, in other words, the premiums you're paying for nearby delivery of a home are way through the roof. Let's look at the data that just came out because there's an opportunity here. Building permits, still less than 1.5. They were up a little bit for the month, but less than 1.5, which is a seasonally adjusted annual rate, SAAR. All right. So permits less than 1.5 million per year. Starts less than 1.5 million. All right. When you go back to the 70s, 80s, and 90s, starts have been well above 1.5 million. 1.5 million is a level that is way below what's needed because you got 40 million more people living in the country now than you did in the 80s. All right. That's just as simple as it gets. Single family home starts are below 1 million and at the levels that we saw in the 1990s. Not only that, they have been negative relative to like kind of what you would say would be like a 5 or 10 year average for an entire period from 2007 and below 1 million from 2007 till 2019. It's 12 years of lost growth in single family home building because of the crisis in 2008 and 9 that we just came out of. Then the pandemic hits and now we're just trying to climb out of it and we're not still even out of it. Single family homes under construction. Right now, currently under construction, down 15% from last year. Home completions, still below 1 million, and down 5% just this past month. No wonder the NAHB survey is so negative, even though you would think that for home builders, this is nirvana. It's not nirvana because the traffic of prospective buyers is so low because affordability stinks. It's price and it's mortgage rates. So mortgage rates will come down. Price is not going to come down. But at least you'll loosen up the affordability a little bit. And you will have the traffic of prospective buyers rise. But right now, the traffic of prospective buyers has only been worse at a rate of 21 is the index. All right, it was 40 3 months ago. There's only 3 other times it's been worse in November, December, which is typically a seasonally bad month, but doesn't mean it's always bad. But this is so bad. The only other times you've been this bad in November, 2022, last year, 2007 through 11, and 1990. So how about the builders? The builders have taken off. These stocks are already so hot, they're through the roof. All right. It's like a rock star band right now, the home builders. Let me introduce you to the lead vocalist, Polte, international superstar. How about the lead guitarist? It's like Led Zeppelin-like. We got Jimmy Page on lead guitar, Toll Brothers. You got Lennar on drums, you got K&B on bass, and there's your rock star band for the home builders. All right. The XHB, almost at new highs. The ITB, even better. All right. You don't have things that are linked to kind of remodeling, and the remodel index is way up, by the way. Is way down. So you see remodeling has come down. Refinances, of course, have collapsed, the whole 9 yards, right? But home building is still there. ITB is the home construction ETF. That's outperformed the S&P 500 by 30% over the last 52 weeks. The XHB is up by 18% against the S&P over the last 52 weeks. But those have taken off already. I'm not saying you buy them here, although there's probably still upside. But something like lumber. Lumber gets back above $593 per thousand board feet. That would be a major breakout. Lumber got to $1,700, came down to $260, and is back to $600. And at $600, it would be a record high for any time prior to 2019. See, that's part of the problem with this inflation that people don't understand. Even though lumber is down 81% from its peak, it's at a level that prior to 2019, for the history of 50 years before that, tracking these commodity prices, would have been a record high. Wood is the global timber. Cut is the U.S. lumber and timber and forestry ETFs. Those are definitely potential buys. Some of the individual shares in there are much better than the index itself. So it may be a stock pickers dynamic. We have thoughts on that too. You can certainly email me at sales@weldononline.com, sales@weldon, W-E-L-D-O-N, online, one word, weldononline.com. And I will send you reports on housing, or if you want the metals report or you want the playbook, I'll give you a sample of what we do here and give you a better idea and we'll help you understand some of the things we even talk about in the podcast. I mean, the MBB, which would be the mortgage bond ETF, kind of bottom. There's a bunch of REITs that look pretty good here with major long-term uptrend breakouts. I mean, they go back to like 2007 highs that are being broken, those downtrends that have been in place now for like 15 years. So it might be the hottest sector out there right now. So we'll see. Email me if you want some more information. We do the global macro strategy report, which is daily, and it covers everything all over the world. Also do the portfolio playbook, which is U.S. stock centric, covers the sectors, gives various portfolios depending on what kind of investor you are. We can't possibly know what everyone's doing out there. And then my discretionary portfolio, seeking to outperform the S&P 500, which has done tremendously well this year. And then, of course, hit us up on Twitter, which would be money_podcast, or on Twitter at money_podcast, or follow me still at Weldon Live, which is the former product. We just rebranded it to make all of it consistent with the podcast and the portfolio playbook. So the Weldon Live is now the global macro strategy report. You can find me still on Twitter, though, at Weldon Live, and definitely check out YouTube. A lot of free stuff on YouTube, a lot of videos. It's Gregory Weldon, user /Gregory, Gregory, Weldon on YouTube. Thanks for listening. We'll catch you next time on Money, Markets, and New Age Investing.